So first of all, to all the attendees, thank you very much, ladies and gentlemen, for joining us, taking time out of your busy schedule to join us in this GCX webinar. We're really going to be scratching what I think is a little bit of a topical sore point. The question is, does ESG strategy really influence my short-term cost of capital? To help us build this picture, we have some truly formidable and clever people around the table, providing us with different perspectives. First off, we've got the capital owner's perspective. So Belaina Negash will be taking us through how her organization, the Government Employee Pension Fund, arguably the largest investor, or definitely the largest investor in Africa, is considering ESG. Belaina has extensive responsible investment experience. I won't run through a full CV, but suffice to say that she'll be taking us through a short introductory presentation on how capital owners or asset owners look at ESG and investments. For the next, we have Gareth Allison. Gareth Allison is the Executive Director and Sub-Saharan Head at MSCI. MSCI, as many of you will know, is a company that has a profound influence on how investors are informing their decisions, investment decisions. And Gareth, from my personal experience, has a wealth of knowledge in how global investors are already using ESG as a decision point in their equity and debt investments. For the lender's perspective, we've got old Mike. Mike Mortimer is head of the Absa Bank's unlisted commercial property finance business. He also brings with him a wealth of knowledge in the decision factors that influence the allocation of debt or the provision of debt. And I'm particularly interested to hear his perspective, specifically his role in the unlisted space, in the private space. And then hopefully we'll have a chance to enjoy the input of Giles Pendleton, the effervescent Giles Pendleton. I'm not sure if he's with us yet, but he's having a bit of an IT issue. He brings two perspectives to the table. The first is as chair of the Green Building Council of South Africa, and the second is as the Chief Development Officer for the listed property fund Attacq, the REIT. So hopefully he will be able to join us, but if not, Tamlin, when he does come in, then please raise a hand or send me a WhatsApp or whatever we do nowadays on text. I'm not sure, there's so many channels of communication. Maybe just pick up a telephone, the old ones, and I'll be on that call if you need me. But Giles, when you do join us, we look forward to having you. So for now, a little bit of housekeeping. The format is going to be ideally as much conversation as we can between the panelists. Unfortunately, those participants that are joining us are muted. We will be, however, taking your questions via the chat box. So feel free to type in any questions in there. I will deal with them as they come up. Those that I can't deal with, we will hold back and I will respond to you individually. This webinar is going to be recorded and will be made available to you as participants, as panelists, once it's all done and recorded. As I said, it's a conversation piece. So what we'll do is we'll start with Belaina's short presentation to set the scene. I'd then like to turn to Gareth and Mike to run us through their perspectives of ESG and the role of ESG in the allocation of investments and effectively whether it can influence short-term capital, cost of capital. And then I'd like us to move to almost a conversation where ideally Mike can ask Gareth or Belaina a question, Belaina can ask Gareth or Mike a question, and I can stir the pot in the middle. All right, so kicking off with that introduction, we've now got a healthy group of participants on board. Belaina, if we can move to you for an introduction for your perspective on ESG and investing and the cost of capital.
Thank you, Phil. Have I got the right one? Okay, great. Thank you everyone for joining us this afternoon. My name is Belaina Negash. I'm a research analyst at the Government Employees Pension Fund, and I'm going to share with you our approach to ESG. So on this agenda, who is the GPF, our approach to RI, the aim of responsible investing, and what research says, and I'll just run through a quick case study. So who is the GPF? We are a defined benefit fund. We provide pension benefits to government employees. We're the largest pension fund in Africa. We've got 480,000 pensioners and beneficiaries. We manage 1.8 trillion rand, and we are a founding signatory to the United Nations Principles for Responsible Investing. So the GPF responsible investing policy stems from the fact that we believe that implementing a strategy that ensures that responsible investing issues are integrated into investment decisions and asset owner practices in a manner that is consistent with our strategic objectives. We believe that it can enhance returns, and a number of key factors support this belief, and that is our 14-year membership to the United Nations Principles for Responsible Investing and our investment beliefs. We also believe that we have a role to play in society, and we recognize the importance of ESG in investments. So this diagram is just really to explain how, from beginning to end, how we use ESG factors to screen investments. We evaluate our ESG risks. We monitor our companies that we invest in and how these companies improve over time. And whilst we're doing that, at the same time, we do also create a dialogue for deeper ESG engagement. And at the end, of course, that would be reporting to all our stakeholders, including our board. From a strategic perspective, we've got the responsible investing policy. On a tactical level, we've got our responsible investing management framework, which outlines how exactly we intend on doing that. Now, this statement is quite something. If we knew what it was that we were doing, it would not be called research, is it? But the reason why I put this up is just to explain what exactly does the research say out there. Are we just doing this for fun? Are we doing it because we believe it's a good thing to do? But the numbers really do show. This diagram comes from the World Economic Forum. It's a global risk report that just highlights what exactly our risks are. What are we dealing with? What are the evolving and emerging risks? Today's risk landscape is largely shaped by climate change and related environmental issues. As you can see right at the end, all of them relate to the environment. This also links to how it affects our investments, how it affects our members, and our global environment as a whole. What type of place are we living in? So the question begs, what do the facts say? What does the research say? Some of the widely accepted finance theories stem from a risk-return analysis. And this, as I'm sure a lot of you would know, is modern portfolio theory, efficient markets hypothesis, capital asset pricing models, etc. But the nexus of these models are really concerned with systematic and not idiosyncratic risks. The exploration for a positive correlation between ESG risks and financial performance can be found as far back as 1970. In 2012, Deutsche Bank concluded that companies with high ratings for ESG and corporate social responsibility have a lower cost of capital. Also, a joint Deutsche Asset Management and the University of Hamburg examined over 2,000 ESG and financial performance academic studies that have been since published since 1970, which resulted in saying that 90% of these studies displayed a positive ESG and financial performance relationship. So that is what the facts say. That is what academic studies say. Now, what I intend on running through is just a case study, and I chose to look at climate change. So this quote from the United Nations Environment Programme says that climate risks are increasing the cost of capital for developing countries, which further exacerbate the economic challenges already faced by poor countries. The researchers also estimate that these additional costs are set to rise between 146 billion and 168 billion over the next decade. So what does this mean for us? What are the main drivers behind this? Some of the things that we as asset owners have realized is that there's various factors that affect us, such as pricing uncertainty. As we've seen oil shocks, we've seen the talk of stranded assets as well. There's also asset owner pressure. You know, if the questions are, what are the risks to our portfolio? According to the UN, there's going to be a reduction in expected returns of 6.6% over the next 35 years. So what does that mean for our portfolio? There's also regulatory pressure. We've got the Paris Agreement, which South Africa is signed up to. We've got the National Development Plan. We've got the Sustainable Development Goals. We've got Regulation 28 and the FSCA Directive on Sustainability Reporting. And then also consumer pressure. People simply just do not want to buy products from companies that seem to do bad things. My case study is just going to demonstrate what happened to Standard Bank. Asset owners filed a shareholder resolution relating to climate change. We wanted the bank to disclose funding relating to carbon-related assets, and we wanted the bank to adopt and disclose a policy on financing coal. So 55% of shareholders voted for it, and therefore that meant that the resolution was binding. And subsequent to that, Standard Bank had a policy on funding coal. So what does that mean? It means that asset owners, we've got a huge responsibility. We've also got the power to effect change. So in conclusion, we need to understand our emerging risks. The research definitely says that ESG does affect cost of capital, and we've also got emerging trends. And we also need to understand our power as asset owners. Thank you.
Thank you so much, Belaina. Short, powerful, and definitely demonstrating the point that as owners of capital or allocators of capital, you have the ability to really drive the agenda of ESG. It's interesting to me that you use the word responsible investing, and then ESG almost as a subset within that construct. One of the key learnings out of my short little foray into the space has been the fact that ESG language is non-standard. There seems to be a lot of language talking the same thing, but trying to say the same thing, but using different words. In particular, you referred to a term called ESG factors. So opening with that as a thought and opening the door for my good friend Gareth, Allison, perhaps a conversation around how global investors are using not so much the asset owners, but potentially how MSCI or other institutions are providing tools to the asset owners and the investors to consider these ESG, and maybe bringing it a little bit closer to home than pure research. Over to you, Gareth, for your opening gambit on whether ESG has the opportunity or is already influencing short-term cost of capital.
Sure, Phil. Thank you, and good afternoon, everybody. And thank you, Belaina, for that intro. It was very insightful. And maybe I won't delve too much into factors, but just try and give a couple of thought-provoking points. Both on our domestic experience and what we're seeing with some of our other global clients. I think first I'd like to make a distinction between SA Inc. and sort of the SA investment landscape compared to the rest of the world. I think if you sometimes, sorry, and I'm English originally, so when I see South Africans be down the country and down on the system, I think sometimes they forget, and actually South Africa from an ESG, sustainable RI governance perspective is actually on a par, if not better at some points than some of our global cousins. A lot of people refer to the King Code as part of that significant governance, and that's a massive contribution to global best practice. And if you look at South Africa from an ESG perspective, and whether you analyze it from a sustainable development, from a climate, from a ESG perspective, actually some of the issuers and that we have here and the companies that work here are amongst the top in the world in terms of their ESG profiles, and by that I mean how they manage future key issues or material issues they may face in the future around environmental, social, and governance issues in their industry. So, SA Inc. itself has a good reputation, and from a perspective of looking at global issuers, far exceeds our fellow emerging markets in terms of the leaders that we have in that field. I think the second point, with regards to the local investment, and I think the GEPF and Belaina and the team stand out from a large part of the industry in terms of, one, the length, and two, the depth of the ESG integration and work they've been doing over the years. I think South Africa, yes, is starting to catch up over the last couple of years in terms of taking ESG into account, integrating it into investment decisions, filtering investment decisions, or using it as a lens alongside other factors to make investments. But I still think by comparison to global peers, there's quite a lot of strides still to be made. Belaina made the comment around the pressure on Standard Bank and fossil fuels and AGM discussions. Those are amongst the first to be seen last, in terms of, from a South African perspective, but those have been part of, some issuer conversations globally for a number of years. When we look at, what we're starting to see, and I talk about the ecosystem because I think we're all linked from the sell side, the buy side, the asset owners, the issuers. I think it's all part of that circle of conversation in terms of how do you use the ESG conversation to find a better outcome. Belaina mentioned some studies, Deutsches from 2012, and some of the more recent ones really showing that taking ESG factors or ESG ideas into account in investment really does come through in the various transmission channels when you look at understanding issuers, whether that be understanding cash flow channels, how companies are valued, what future risks, ESG risks, and the impact that will have on cash flows and the quality. I think you probably don't have to look too far back to see the impact COVID had on global markets and some sectors in particularly. Whether you want to look at the idiosyncratic channels, those companies that are better governed, that have better management practices to mitigate some of those ESG risks, will have a lower volatility and will perform better through time. So, I think those studies are there. I think there may be a gap slightly in the South African environment to see how that has played through. It's something we've done with a few clients. We've been working here in this sphere now since 2012. In terms of the local landscape and understanding that, and our analysis of the COVID year to date really did come through that those higher quality companies did tend to perform better than those more exposed to ESG factors over the sort of 6 to 9 months that we've seen. Maybe tying it into when maybe the conversation will be going, and then I'll keep quiet, is very much around the cost of capital. A lot of the conversations we've had here on the sell side and tying of ESG-linked loans or sustainable finance loans is how does that link through to the direct cost of capital of the company? What does it physically mean? I think the explosion of these type of loans or credit facilities globally is starting to give us insights on that. We've had a couple of examples. I think the sustainable linked loan universe in Europe doubled in size in 2019. 2018, and we've yet to see what the 2020 figures are going to show that. But clients were actually seeing a change in rating score or a notch up or notch down could equate to anywhere between 2.5 and 5 basis points change on their cost of capital, related to how they manage those material risks. So again, it'll be interesting to see how that starts to play through, and if we see something similar in the South African environment. Anyway, hope that's good as a starting point.
Thanks, Gareth. That's fantastic. Yeah, no, definitely. And having the quants or the numbers behind being able to say, for example, 2 or 5 basis point change in cost of capital linked to your ESG performance. Now that's a material number, because our conversations, or my conversations with these C-suite executives, is that they are struggling to make those links in SA Inc., as you call it. So perhaps we are a little bit behind in that space, and that pulls us straight into the hot seat. I see Giles has joined us. Welcome, Giles. We'll introduce you in a bit and bring you on board for your opening gambit. But straight into the hot seat, Mr. Mike Mortimer. So, is SA Inc., or how do you guys incorporate the environmental, social, and governance risks, or how companies are managing those risks into your decision points around the providing debt? Over to you, Mike.
Thank you, Phil. Thanks. And I think it's, it is, I suppose, just appropriate at the outset just to emphasize the commitment that we as Absa do show to ESG and the various sort of initiatives and projects we have underway in that regard. We have a very comprehensive group sustainability and coal financing, as an example, standards that we're developing. There are various initiatives we are looking at in terms of just aligning with the broader needs, and the broader imperative that comes with ESG. There's a lot of conversation happening at the moment with the Banking Association of South Africa, just to ensure standardized reporting. And I think that, it has been mentioned already, but that's one of the clear challenges just in terms of standardization and sort of transparency of data. So there's a lot of conversation going around that on the one hand, and then just sort of managing carbon footprint of the different banks' lending books. So, that's taking place. And then we have a multitude of responsible sort of lending guidelines and principles that we are in the process of implementing and have implemented already. Why? Well, quite clearly, we as a bank look to continually play a shaping role in society. We're very mindful of sort of climate change and the impact that that's having just in terms of broader socioeconomic consequences, not only in South Africa, but certainly across the globe and across the continent. And to that point, we as Absa have a very strong footprint across the African continent. So whatever we're trying to do, we're looking to standardize across all our African jurisdictions. And a lot of that work is going on. I do think, however, it's important to say right at the outset that, we don't see, and that is the challenge right now, immediate funding benefits. So in other words, our cost of capital is not automatically reduced if we are funding into ESG development. One that we've identified or can be objectively identified as ESG. So that is the sort of, there's no direct benefit. But in having said that, what we certainly do see is the impact that ESG principles and ESG disciplines have, as an example, into the valuations process. So, when we're looking at valuations and when valuers are undertaking their exercise, certainly there are factors that get taken into account unquestionably from an ESG point of view. And if you look at, just in terms of sustainability of the buildings, risks of obsolescence, natural sort of things like natural heating, natural cooling, power supply, et cetera, on the one hand, those will have direct impact into operating cost efficiencies, which we feed straight through to net income and ultimately into cash flow and value. But then there are also, I suppose, more indirect benefits that you will see through, just demand for those buildings, sustainability of those buildings, and then consequently market appetite for them. And that, I suppose, would typically transfer to things like discounted cash flow rates or cap rates, which would impact then onto valuation. So on the one hand, as I say, no direct benefit through cost of capital, but certainly indirect benefits through the way in which these buildings are viewed. And then if when we start looking, then we would apply a similar lens to how we assess the risk. So, we would look, when we're running our stress testing, we would look at power supply, we would look at sustainability of that, we'd look at demands, that would, or risks that would be inherent in in a building that's running a risk of obsolescence or doesn't have the necessary sort of ESG, let's call it, benefits that would, that potentially would run obsolescence and sustainability risks. And, when we run our stresses, those would certainly be affected in. And then, we have fairly sophisticated pricing and risk models, and these factors are all taken into account in that. So, as I say, the short answer is no direct cost of capital benefit, and there's a lot of work afoot in that. We can talk about that and things like green lending bonds and green loans, but certainly indirectly, there definitely is a clear impact that it has. It's also fair to say that, if you look at our business, and I'm not talking about just the commercial property finance business, but the business more widely, the business of lending in Absa, we have provided some fairly attractive green bonds, certainly one to one of the larger residential developers on our books, where there's a significant benefit being passed on by our home loans division into buyers into that development, which has been classified as a green development. And that's, as I say, a material benefit they're seeing. And then perhaps not to the same extent, but certainly attractive, appliances that are actually getting installed into those developments are getting substantial discounts based on their green rating as well. So, as I say, those are perhaps, that's one area where there's direct benefit being seen. But I think, again, it is also fair to say that we see the broader imperative there. It's certainly something we're largely supportive of, but it is those benefits we are passing on to those end user home loan clients are benefits that effectively the bank is absorbing, or costs that the bank is absorbing directly, as opposed to seeing that through direct cost of capital reduction.
Wow, that's interesting. Maybe a trickle will turn into a waterfall then. So maybe the trickle that we're seeing around the residential developer benefit, and there's I suppose in a very roundabout way, that is reducing the cost of capital of the individuals that are getting those loans, because they're paying a slightly lower rate because they're prepared to buy green. So there is that link. I think it's a wonderful intro to our next panelist, Giles Pendleton. Judging from the backing behind you, I'm assuming you're going to be talking more about the Green Building Council, because I would have expected developments if you were talking more to Attacq, but we are expecting you to give us a perspective on both. Giles, an opening gambit on your view of whether ESG performance is impacting on the cost of capital, potentially speaking on behalf of the REIT, but also your view from the Green Building Council as chair of that organization. You've lost your mic, unfortunately. Try now. No, I think your mic is dodgy. We have got you. You're showing as unmuted, but we can't hear you, unfortunately. If you'd like to try and work it up, maybe turn it up. One more time. No. Okay. All right, Giles, not a problem. You're welcome to stay on the line and listen to the conversation, or you could potentially even chat in, type in your questions that you'd like to raise to the other panelists, because I have no doubt, having had a conversation with you fairly recently, that you have some questions for particularly the debt and the investor panels. Perhaps you'd like to log off and log back in again and give it another bash. In the meantime, if I could ask Belaina, Gareth, and Mike to unmute yourselves so we can have a round table conversation. I do want to maybe kick off, Belaina, with you, and to focus on that point around language, responsible investing. Very often we tend to see this ESG. My experience has been that ESG in the developed markets has now become quite a contained conversation. People understand that ESG, they understand ESG ratings, particularly of the corporate issuers, but they also understand what fits into those boxes, the issues and the themes that table that you had showing climate and data and all those sorts of ESG issues. And in the developed markets, I find that that's quite well contained. There seems to be a very common taxonomy, common understanding. And yet when you, in South Africa, you would use the term responsible investment. I've even heard corporate social investment starting to get mixed up in this conversation. Is there a distinction between those, between what is responsible investment, what is corporate social investment, and what is an ESG factor or ESG risk in your world?
All right, so thank you for that question. In my world, responsible investing speaks to a broader theme. It's more of how do we do things, and ESG are specifically looking at risks or factors that would affect the broader responsible investing umbrella, if you want to think of it that way. Also at the fund, we also look specifically at what are the factors that would affect that, our investors, or our investments. And so that is how we refer to ESG. And yes, it is true, it can be used interchangeably, but we could also throw in the impact investing as well. So the lines do get blurred. But for us, RI is a broader term, a broader umbrella, and ESG is looking at specific factors.
Great. Okay, Giles, you want to give it another bash? No. I can give you a third option, which is potentially to plug in your phone and to connect through your phone and see if you can't perhaps get a volume there. It may just be Zoom that's banned you, a bit like those bullying things on Facebook. It's because you talk too much, Giles. No, not to worry. Okay, let's keep on trying. So again, I don't know if anyone else has got questions for Belaina, Gareth, or Mike. But Gareth, this whole thing around ESG ratings, there does seem to be a real acceptance of ESG ratings now by the investors. So instead of them having to do their own work, they are now relying on, if not the MSCI ESG rating, then the Sustainalytics or the FTSE Russell rating. And they're starting to see that as a way to potentially link their cost of capital story. So less their cost of debt or even their preferred allocation. What tools are you seeing investors around the world using almost to simplify that process rather than having to go out and fully understand whether a company is doing the right stuff in ESG?
Yeah, sure, Phil. I'm happy to throw some things out. Look, I'd probably disagree with you on the first part and say that I don't think there's broad acceptance yet. I think if you go to anybody who's maybe the field we have here are well versed in the areas of ESG, RI, sustainability, and how it affects our businesses. I think there's a large portion of the investors who are still trying to sort of find their way, and if you look at the way different businesses and same industries compare, there will always be divergence. And I think you've seen a lot of arguments around the divergence between some of the ratings that would come from us versus other companies. I think if we would look to then say, well, let's take that out of the equation and what are clients looking at? Look, I don't think it's anything different to what investors have been looking at for, MSCI has been around since the early 70s. It's, assistance on transparency into an area that's becoming increasingly important when you make investment decisions. And what does that mean? It means they're looking for assistance in taking some of the operational data headaches around. I think if you look at availability of corporate information, yes, it has increased significantly, and I know asset owners and universal owners, the likes of the GEPF, have done a lot of work in terms of promoting increased reporting. But where do you find that data? How do you normalize it? How do you make it comparable? How do you then take a report from a company in Japan and compare it to a company in the US and make an investment decision based on that? So it's a large part of it is that operational efficiency of taking, my job is evaluating decisions in my role. have I got the time to go and scrape data off NGO databases, global databases, and normalize it and maintain it? I think the second is to bring some level of framework to, once I've got that data and understanding, is how do I start analyzing all the companies, all the issuers in an ESG framework? And I think there again, they're looking to people like MSCI and other providers in ESG, as they have done in indexes and other areas, real estate analytics, to provide a framework that you can literally just shine a light in and start doing the deeper level understanding to get a better view. And then I think the third area is where clients are looking is somebody who's going to keep doing this over and over again. And as Belaina's pointed out, and Mike as well, and I'm sure Giles would have said, and on the side, I think you're only picking on Giles because he can't answer you back. Is that the number of acronyms in any area of finance, I think, is always an indicator of how much development still needs to be done. I think when you look in the area of risk and VAR, everybody accepts what that is. They understand how to build it, but the fact that you've got multiple acronyms around sustainability talks to the fact that there are so many areas of this. And so the third part is having a partner or having somebody there who through time is going to enable you to analyze all these different areas, whether it be ESG ratings, so future material risks, whether it's understanding climate, carbon intensity, or future climate risk around transitional physical risks, aligned with your country's NDCs. So for me, that's what people are looking for. It's that operational efficiency. And then the final thing from an MSCI perspective really is knowing that we are sitting there talking with other people around the world with the same problems, and those problems and solving those problems then feeds into the products and offerings that we deliver to local clients. So I'm always proud to be able to say I've got 3,300 other people I can ask a question of and get their experience to answer a local client's question.
So Gareth, it's been an interesting, it's probably the stemming point for the question we wanted to ask in this webinar, which is, the C-suite or the executives in companies there's a moral imperative that they have to say, we're prioritizing ESG, but the amount of effort and the amount of cost, both human and financial, in order to get this data to be able to answer the questions that are being asked by investors accurately is intense. It's immense. And these guys, particularly during COVID, are just trying to keep their businesses afloat. So this question around providing so much data and providing so much information is an interesting one for me, because effectively what we're saying is that this is almost becoming it's a whole new position. You need to employ people to do this, and that is quite expensive. But and then this comes back to Giles. Maybe if you are able to hear us now, maybe you can talk on this point. What we're trying to get to here, and the elephant in the room here, is that all of that effort, all of that cost, all of this talk around how important it is it seriously impacting my cash flow? Is it seriously influencing the flow of investors into my shares? Do I get a share premium for it? As Mark's already pointed out, even South Africa Inc., there isn't a direct link into the cost of capital or cost of debts yet. And so, Giles, in your headspace, if you can hear you, are we going to see an improved? Do you think we are seeing some link into the cost of capital of all of this work that you're doing on the ESG side? Try again. No, the world is okay. Yeah, no, I got that part. That's okay, Giles. Mike, maybe you can jump in your conversations, because I suppose in your models, the fact that you're looking at obsolescence of buildings and you're looking at sustainability, you're having to collect a lot of that data from clients. Are they able to provide it in a meaningful way to inform your decision, or is it still a little bit iffy and butty and potentially not strong enough for you to be able to provide or build an investment case on the back of that data?
Yeah, Phil, I don't think it is. Certainly, there's not a degree of consistency or standardization, as you mentioned, and as Gareth has said, there's a minefield out there just in terms of trying to understand this broader excuse the pun, environment that we're operating within, and the sort of key triggers and measurement criteria that pertain to it. So, if we're looking at it, we typically are looking at it on a case-by-case basis and applying, I suppose, our subjective, as are our clients, their subjective sort of viewpoints to that in looking at, as I say, the sustainability, the operational efficiencies and the like. And I think it is also fair to say that, there is quite a difference certainly between, let's call it the larger public entities and the unlisted entities, because, I think there is unquestionably a greater, reputational considerations that would probably come into play in some of the bigger public entities, and having the right face to market in terms of ESG and the like. Insofar as the unlisted entities are concerned, where you don't necessarily have a massive shareholder base you're accountable to, and your commercial decisions are often real time and short term, there's no question that generally speaking, people wish, to support whatever ESG initiatives they can, but not at the expense of the ultimate feasibility of the development or the investment. And so, it gets back to the point that if interventions that serve an ESG purpose ultimately improve the value / cash flow of the asset, then those will be embraced. But, in the absence of that, it's a subjective decision, as I say, that we will take on a deal-by-deal basis, looking, alongside our valuations and building project management teams and the rest of the experts in the bank at the particular asset itself, rather than, referring to a broader set of standards, criteria, definitions, or measurements.
Yeah, no, it's okay. So it does seem to be, and I like this part of the conversation because it is bringing a little bit closer to home. Now, Belaina, we still can't hear Giles, but if I was to bring it to you, you've got an allocated, a legislated investment manager in the PIC. Is your influence in the space? You did mention the asset managers as one of the spheres of influence. Do you specifically consider ESG in your mandates? Do you enforce it? Do you have any tools that help you monitor whether there's an investment in ESG or what the tilts might be within that?
Yes, we do. Thank you for that question. So we do have an investment mandate with our asset manager. We also do spell out specifically ESG factors within that. Also, Mike did mention about private equity investments. We do also have key development areas that we contract our asset managers to fulfill. So, and that is why earlier I spoke about the broader RI umbrella, because our RI framework is universal to all the asset classes. It is sector agnostic. It is asset class agnostic. It applies to all our assets and geographies as well.
Okay, that's interesting. Gareth, coming across to you then, you're finding, Mike, so maybe a little bit of perspective on your experience with asset managers in particular. Do you think that they are, you think they're asking the right questions? And this is a difficult one for you, I'm sure. But do you think they're asking the right questions of what you refer to as the issuers, the companies that they're buying? And do you think they're asking those questions forcefully enough? Or do you think in SA Inc. that it is still a ways off from being a material contributor to their stock selection decision?
Oh, put me on the spot here. The usual MSCI disclaimer, right? No, look. I think for me, Mike summed it up, right? It is one of the comments is, and to your comment earlier, right? There is so much on the plate of every issuer CEO. I would imagine, Mike and Belaina's inbox, everybody that's involved in the market, there is already a lot on their plates. So having to deal or having to look at additional factors or additional metrics or report on additional metrics then just puts additional pressure. I think to take Mike's point, and this is where I think international research is starting to help the conversation is that we're starting to see the example I used when was an Austrian company, that 2.5 bips, and that's actually used in their presentation. The moment the companies see there is a financially relevant impact of this on their business, and I think the same talks through to sort of the asset managers. A lot of the conversations were, and I'd be interested in Belaina's viewpoint on their members, is I'm not willing to give up return for sustainable features. What's in it for me, sort of view. But I think the Deutsche Bank studies we've done ourselves on how ESG transmit into, the more that research is coming through and showing actually you don't have to give up the return. In fact, you can get a better risk-adjusted return. And I think the risk side, as much as a foul word that might be in South Africa at some points, that risk element of the return is as important as the return element and the ESG element. So I think as asset managers are starting to understand and see physical examples of governance issues, environmental issues playing out in their portfolios, they're starting to be more integrated in the way they look at it. The challenge they then face is, how do I integrate it? And so when I talk about South Africa Inc. and South African investments over the last few years, we've seen a lot more integration happening into portfolios than we did 3 or 4 years ago, where those factors are being introduced into their fundamental discount models, in their portfolio construction. So very much more integrated. But again, it's still developing. SA investment is still developing. The one thing I would say, and obviously apologies if Belaina, you were going to mention this, there is a new draft of CRISA that's coming out. There are new discussions around, Belaina mentioned sustainable reporting. I think the one difference that we see between South Africa and international markets, and here I'm talking about the Paris-aligned benchmarks indexes you spoke about, TCFD, is the regulatory teeth to follow that hasn't maybe necessarily been there to push it through. I don't know what Mike or Belaina think about that.
Mike, your views?
I suppose just looking at the conversation around asset managers. So I suppose I've been quite blunt in my feedback, in terms of pure cost of capital, and the fact that that's in a direct manner not feeding ESG considerations, and not feeding directly through into. I suppose as a bank, what we certainly do, and we have some very bold ambitions in terms of what we'd like to achieve in the next 5 years in terms of broader capital raise, and that's looking at green bonds and various initiatives around capital raising. And, that then goes beyond a bank's traditional source of capital. And that's again where I think, on the one hand, reputational considerations, broader, perhaps altruistic concerns, sustainability thoughts, clear, transparent, objective, measurable criteria would all play into that kind of initiative. So I think that's where you go into a broader investor base. And there is where you're looking to raise capital at perhaps some level of discount to what you would source it through your traditional avenues for capital. And, I think that realistically is where we are like to see benefit. But, as Gareth, Belaina, yourself have said, there are a lot of enablers, and not even in fact enablers, essentials to that process. Not least of all is just decluttering this whole process, getting a greater understanding, getting a greater transparency. And I think through organizations like MSCI, a far more clear, consistent and measurable set of criteria that, there are, you look at the indexes around the world, sustainability index, FTSE for good index, and various other indices. And those are the sorts of things, I suppose, that we would be looking to as a bank to sort of work with, and make use of in terms of taking these initiatives to market and arranging capital raises along the spaces. Because I think that realistically is where the benefit will start flowing, as I say, as opposed to your traditional sources of capital and capital raising.
Yeah, no, I mean, it's completely taken on board, and I appreciate the bluntness of your response, because I can back that up. My personal experience chatting to the executives across the country is that they completely buy into it. I mean, they know that it's a long term, it has an impact on both reputation, but also on the sustainability of their business. Unfortunately, it's the short-term impact when we get through stages like this, when we're going through a tough cycle, and we will be intending to go through, potentially in a tough cycle for the next 3 to 5 years. At those times, what you don't want happening is that we sacrifice those long-term sustainable objectives in order to ensure we shore up the cash flow, because that's counterproductive. And so I am putting it in the hands of the likes of Belaina, the likes of the PIC, the likes of the asset managers, and the likes of Gareth and MSCI to make this process a little bit more easier to join the dots between, if I do this in the long term, I'm going to get 25 bips off my cost of debt. What I'm hearing in this conversation is that maybe it's too difficult for the banks to do that straight away, because those measures that inform that business case are just too convoluted and potentially a little bit too disparate.
Yeah, and I think on that score is just, as I said, there's also going to be blunt commercial considerations. So the average Investin developer is fully supportive of it, provided it makes economic sense.
Yeah.
So that's the other one.
One of our participants said that the chocolates buy the money buys the chocolates, or something like that. So I get that, but I also recognize that we have to. It's going to be interesting to see whether asset managers. I mean, there's quite a bit of a hullabaloo at the moment around a specific debt that's linked through Sustainable Finance Division to the ESG rating of a particular company, and that debt doesn't. The bank doesn't have to do the work. They just need to look at the rating, and they'll let the rating agency do that work. So it's going to be very interesting to see whether that catches on, or whether that is a reality in the market. And whether it transfers across into the equity side. Are we going to see the likes of a GEPF? Belaina, I realize you're not going to be able to answer this question, don't worry. But will we see the likes of a GEPF saying that, we're not going to invest in companies that have an ESG rating of below a certain level? And unless you get above that level, we're not going to allocate our capital, or we're going to allocate less capital to you. So I think my sense is that SA Inc. may be behind in that process, that some of the developed markets are moving faster. But I do look forward to the time when that happens, because I think that there are some companies have really got ahead of the curve in that space. Anybody else have any other thoughts? We're going into the last 5 minutes. Unfortunately, Giles hasn't been able to join, but Belaina, yeah.
Phil, sorry, I just wanted to add to that statement or comment that you made. I think the question also in the context of emerging markets, and specifically in South Africa, I don't think we have the luxury of making such a bold statement, because when you are taking into account ESG factors, you also need to take into account how it affects the social. How does it affect people? In an economy such as South Africa, we've got very high unemployment rates. And if we decide, or rather, let me remove myself from there, but if a significant investor were to say, we shall not invest in a specific sector, what does that do to the economy? So at the end of the day, it comes full circle. If we continue to, for instance, not finance coal, for argument's sake, where do all those people go? What happens to the economy? So at the end of the day, it's also about, I don't know if there is such a thing as a balancing act, but it is important to consider all the factors, I think. And that, I think, is what a responsible investor should do. It's not just necessarily, cutting off certain sectors, but looking holistically on how the economy that you are living in is impacted.
Thank you very much for that, Belaina. Closing statements, I think, Gareth, we'll start with you. Your final thoughts as we look to head out.
Yeah, Doug, I mean, I'd make two closing thoughts, very short and sweet. And Belaina mentioned it. And Phil, you remember we had a webinar a few months ago with Harold Winkler from UCT talking about, South Africa's climate conundrum. it's that, as Belaina pointed out, it's unfortunately we're not like the other big fossil fuel nor sovereign wealth fund in Norway, who can, has got so much capital they can just allocate it where they want. We have an economy, a financial sector that is so heavily dependent on fossil fuels and electricity generation from fossil fuels, where the transition out of that has to be balanced with our national determined contributions that we've committed to, and that climate glide path. So I don't think it's as easy. I think what I would say is the positive, though, is although it is not happening yet, the opportunities for different ways of accessing capital at different rates for different purposes are increasing. You're able to access green bonds, social bonds. We saw a couple of the first social bonds globally issued, specifically targeting social upliftment. ESG-linked loans, transitional finance loans. The opportunity for raising capital for good, sustainable, the channels are opening more and more. But I think the caveat then becomes, for me, twofold. Taking my MSCI hat off, like Belaina did for her side. A lot of the conversation we have around ESG is pretty much all in the public listed segment. A lot of and I'm not talking about unlisted property. I'm talking about government development banks. They have a huge role to play in this, in terms of either offering incentives for the banks, as Mike said. What's the incentive for Absa, Standard Bank to really push into this segment? What is the additional benefits to the GEPF and PIC over and above their universal owner? They're fully invested in this market's success or failure. How can we achieve that? So look, I think that would be my final sort of comment on this. Is we're making progress. The conversations are on the right line. There are just a couple of more enablers, I think, that need to be put in place, to bring it together.
Fantastic, thank you, Gareth. Mike, any closing thoughts from your side?
Not much to add other than what's already been said. I mean, the example that Belaina used was an incredibly good one. In fact, it's one that I had in mind as well. That just the dichotomy we faced in South Africa between sort of sustainable considerations and the economy that needs to keep moving. And maybe, without getting too philosophical, it's almost a bit of a Maslow's hierarchy of needs. What is more important right now?
Right.
But this is not something we can ignore. I think in some respects, Gareth sort of painted quite a positive picture about South Africa and where we are in the global context in certain respects. But I think in other respects, we're way behind the curve, and this train is gathering momentum. So this is something that we need, and I say we, and it's a very wide we, because there are just so many stakeholders involved here. Need to pull this thing together so that it becomes far less into the economy and has meaningful benefit for all stakeholders. But that's a lot easier said than done right now.
Yeah, but I do think we're walking down that road. I think the fact that we're having this webinar in the first place, and the fact that we're able to talk to that sore point of short-term capital cost is real. I think we are having that conversation. Belaina, to end off, your final thoughts?
I think we are on the right track. The fact that we're having this conversation, and many others alike, I think speaks to the fact that we are, we do have our heads in the right space. It is going to take time, but we are getting there.
Thank you very much to GCX in particular for hosting the webinar and setting it up, to Mike, Belaina, and Gareth, and to Giles for your persistence, your tenacity, and your silence. Thank you very much. We'll send it, as I said before, we'll send out a recording to all of those that signed in and joined us for this. I have seen your commentary. It's been interesting to watch a conversation happening in the chat room as well as on the screen, rather than questions. It's been good to see. I think potentially another webinar along this vein would be called for, and maybe talking specifically to that hot point that came up around the capital cost, or the cost of ESG, and maybe focusing on a term I picked up, which was screening versus so almost not excluding sectors, but investing in the best companies within that sector that inform the agenda. So investing in leaders over laggards. Maybe that's a potential conversation that we can have and might be a slightly less risky way of linking ESG into the cost of capital. So once again, Tamlin and the team, thanks a lot to Kevin, James, and the GCX guys. Hopefully you've got some insights out of this and are able to point your investment and your data tools towards the right, uncluttering that mess that Mike mentioned. And to all the participants that joined us, thank you very much for your time. We'll talk again, I'm sure.
Thank you.
Thanks very much. Bye-bye.